Is 90% of tokenization talk on LinkedIn just pure marketing hype? Yes or no?
Once the big, boring, risk-averse institutions started showing up, it signaled to everyone else that this wasn't just crypto people talking to crypto people anymore. Does putting this specific thing on a blockchain actually add value? Sometimes the honest answer is not really. Honestly, I think tokenized treasuries are a bit overhyped right now. Just to explain, treasuries are basically government debt, like United States Treasury bills, considered one of the safest investments in the world. What I think is genuinely underpriced is trade finance and private credit.
Anastasia, welcome to the show. We are happy to have you here. But before we dive into the world of real assets, could you take a moment to introduce yourself for our audience? Tell us a bit about your background, your current role, and how you got hooked onto the operational side of Web3.
Sure, happy to be here. So, a bit more about me and my background is actually a mix of two things that don't usually sit together. I started in applied mathematics and computer science, then spent years as a backend engineer working on enterprise integrations. So, I come from a very technical place. And funny enough, my first real brush with blockchain projects was back in 2019 at Ethereum, long before any of this was mainstream. Back then, it genuinely felt like a curiosity, almost a novelty. I still remember one project that stuck with me. It was a German company that was tokenizing electricity. At the time, it sounded borderline absurd. Looking back now, it was basically an early clumsy version of exactly what we are talking about today. From there, I moved into product and program management, and that's where I really got pulled into Web3 properly. I was leading a regulated tokenization platform, real world asset tokenization based out of Bahrain. And that's where I ended up owning everything from the blockchain infrastructure side, building bridges between different chains, to sitting in a room with central bank regulators, trying to get a license approved, which is a strange, but honestly a great combination of skills to build. What hooked me on the operational side specifically was realizing that in Web3, the technology is rarely the hard part. Building a blockchain bridge, tokenizing an asset, that's solvable. What's actually hard is everything around it. I mean, making it compliant, making it trusted, making regulators comfortable, making the business model actually work. I found that I liked living in that mess more than I liked writing code, if I'm honest. And right now, I'm actually mid-transition myself. I'm looking at a role that sits right at the intersection again. I mean, regulated custody and infrastructure for digital assets on the B2B partnership side. Can't say exactly where yet. It's still in progress, but it's very much the same what we are going to be talking about today. And somewhere in between all of this, I'm also finishing my MBA at Imperial College London, mostly because I got tired of learning the business side of things the hard way through trial and error on live projects. So yeah, that's me, half engineer, half regulator, whisker, currently professionally obsessed with the boring but crucial parts of Web3 that actually make it work.
Perfect. So now that everyone knows who are you, let's tackle the massive elephant in the room. So a lot of people hearing the word token immediately think like volatile crypto, speculation, and the hype. You say tokenization isn't crypto, so can you break that down for us, like in the very easy wording, like to our parents? How do you see it? How do you see the term tokenization?
Yeah, so this is actually something I ran into firsthand, and it still makes me laugh a bit. when we were expanding our business from Europe into the Middle East, meeting clients face to face, we had early just gotten or were right in the middle of getting our crypto 4 category asset license from the Central Bank of Bahrain, which, by the way, at the time made us the second company in the world to hold that specific license, right after Binance. That's a big deal in this space. But the moment we said the word crypto in a meeting, people's faces would just close up. They would wanna end the conversation on the spot because for a lot of people, crypto means one thing: casino, speculation, volatility, people losing money on some coin that has a dog on it. And here is the thing: what we were actually doing had almost nothing to do with that. We were tokenizing real assets. I mean, gold bars, cargo vessels, air jet co-ownership, leasing, private equity and private debts, and so on. So things that already exist, that already have value, that already sit inside a regulated financial system. We were just changing how ownership of those assets was recorded and transferred, moving them onto a shared secured ledger, I mean blockchain, instead of layers of paperwork and intermediaries. And here is the detail that always surprises people. Our platform at that point didn't even accept crypto as a form of payment. You couldn't come in with Bitcoin and buy a tokenized asset. You paid in United States dollars, Bahraini dinar, or UAE dirham. That's it. So the crypto in our license name was really just describing the technology we used to represent ownership, not what we were trading, and definitely not how people were paying. So that's the distinction I always try to make. Tokenization is the technology. Crypto is the popular sense. The speculative, volatile, meme coin sense is one use case of that technology. And honestly, a pretty small slice of it. What we were building was closer to modernizing the plumbing of traditional finance than anything you would associate with a casino. Once people understood that, the conversation completely changed because then we weren't talking about risk and hype. We were talking about efficiency, transparency, faster settlement, lower cost, and so on and so forth. So things that any traditional finance person actually cares about.
Exactly. Actually, I couldn't agree more. There is a lot of institutionals right now building tokenized products on top of blockchain. So actually, if it's not about a speculation and it's been out for so many years, why are we talking about it now? So the concept like color coins goes back over a decade to 2012. Why did it take us until the last 2-3 years to actually see products that ship? What finally has changed in infrastructure or in the institutional appetite?
It's a great question because the honest answer is this isn't a new idea at all. People have been trying to do this since 2012 with something called colored coins, as you mentioned, basically an early attempt to take a piece of Bitcoin with information about a real world asset. Then in 2017, you had the first tokenized fund. And if I'm not mistaken, in 2018, someone tokenized a stake in a hotel in Aspen. So the concept has been sitting there for over a decade. But for years, it stayed a concept. Interesting on paper, nowhere near ready for anyone serious to actually use. What changed, honestly, is three things had to mature at the same time, and none of them are exciting on their own. First, regulation. For most of that decade, regulators just didn't have a framework for this. You could build the technology, but there was no legal way to actually issue a real compliant financial product on top of it. That only really started shifting in the last few years with frameworks like European MiCA, Dubai VARA, and what we had with the Central Bank of Bahrain and their rulebook. Once regulators built actual rulebooks, tokenization stopped being a gray area and started being something a bank could touch. Second, I think institutional appetite. It's one thing for a startup to experiment. It's a completely different thing when players like, let's say, BlackRock start putting real money into tokenized products. Once the big, boring, risk-averse institutions started showing up, it signaled to everyone else that this wasn't just crypto people talking to crypto people anymore. And third, infrastructure. 10 years ago, if you wanted to tokenize something, you were basically building everything from scratch. I mean, custody, settlement, compliance tooling, all of it. Now there is an entire ecosystem of infrastructure providers doing the heavy lifting. So a person doesn't need to reinvent the entire stack just to issue one product. So it's not that anyone suddenly had a brilliant new idea in the last 3 years. It's that the idea from 2012 finally had regulation, capital, and infrastructure all show up to the same room at the same time. That's really the whole story.
I heard that basically putting an asset into blockchain is kind of like a 10% of work. But what about the remaining 90%? Like no one is talking about on LinkedIn posts. So what does the unglamorous engineering of connecting banks with the blockchain looks like?
Putting a token on a blockchain, technically that part is almost trivial at this point. A junior developer can do that in an afternoon. The 90% nobody talks about starts way before you write any code. And it doesn't stop once the token exists. It usually starts with just structuring the idea itself. Someone comes to you with a business concept and says that I want to tokenize this asset. And your first job isn't engineering at all. It's figuring out whether that idea can even become a real product. Does it actually fit inside the central bank's rule book or other regulators' rules? Sometimes the answer is no. And you have to reshape the whole business model before anyone touches a line of code. Then there is onboarding. Every single client, every investor has to go through proper KYC or KYB procedure. I mean, know your customer or know your business. And depending on this jurisdiction, that alone can be a serious process. On top of that, you've got KYT. I mean, know your transaction procedure, which basically means monitoring the money movement itself, not just who the person is, to make sure nothing suspicious is happening on an ongoing basis. Then there is the compliance checks that run in the background constantly, not just once at onboarding. And before any of that even reaches the public, you usually need your white paper, the document describing the asset and the offering approved by the central bank or maybe other regulator. That's its own back and forth process and it can take a while. And finally, even after all of that, you still need actually land the product on your platform. And it's rarely a plug and play situation. I mean, every asset type is a bit custom. A gold bar behaves differently than a stake in a cargo vessel, which behaves differently than an aircraft leasing structure or governance bond. So each one needs its own setup, its own rules, its own edge cases handled. So by the time a token actually shows up on chain, you've already gone through business structuring, legal and regulatory approval, KYC, KYT, ongoing compliance, and custom platform integration. The blockchain part is really just the least easiest step in a very long chain.
Yeah, actually, you mentioned several times a keyword like regulatory and compliance. You mentioned about MiCA, which, by the way, it officially was started working the 1st of July. We also have Genius Act and Clarity Act. So there's a lot of regulation happening around the blockchain and the Web3 technology. So speaking of things that get complicated, like let's talk about regulatory, right? Like this is like a marathon. It's never ending. It's super hard for companies to ship products. So you managed to get a category 4 license from the Central Bank of Bahrain, if we got right. So who is actually in the room during those meetings? Like How long does it take, and what do central banks push back on the most?
Who is in the room? On our side, it wasn't just me, it's obvious. I had internal leads, and we also brought in an external advisory firm work alongside us, because a project like this needs both people who deeply understand the product and people who've navigated Bahraini regulation before. On the CBB side, you are dealing with several different reviewing teams, because a category 4 license touches exchange operations, custody, and trading all at once. As for how long it takes, the honest industry expectation, the number of people in the region told us to plan for was 3 to 5 years. We did it in 14 months, start to finish. I mean, company setup, license application, approval, the whole thing. Now, why so much faster? I think here is the part that's actually the interesting story. We weren't just filling out a form that already existed. Bahrain's category 4 license existed, but at that point, it had only ever been given to one company, literally one. It was Binance. And Binance, when they applied, already had over 120 million users, tens of billions in market cap, and licenses in more than 15 countries. So for them, this was just paperwork with lawyers who had done it 100 times. We were started with 3 first people, and I was one of them, with a completely different product. I mean, not a crypto exchange, but with regulated platform tokenizing real world assets. The central bank had literally never evaluated something like that before. So there was no template, no checklist they could just hand us. So what I actually built, my real contribution, was the documentation framework itself, the thing that translated our product into language the CBB could actually assess. And it wasn't written once and submitted. It evolved constantly, because every time we got feedback, the picture got clearer. We started with the technical architecture, then we had to rebuild around investor protection and the risk model, then Sharia compliance alignment, because that matters in Bahrain, then AML and CFT policies, business continuity planning, penetration testing, security operations, even how we managed cryptographic keys. What they pushed back on the most, honestly, was always the same underlying thing, proving that a genuinely new kind of product could be trusted with the same rigor as something familiar. Every round of questions was really them stress testing whether we understood our own risk as well as they needed to. And here is the part I'm proudest of. That framework didn't just get as approved once. We reused the exact same structure without rebuilding it from scratch for our European applications with MiCA, UAE VARA, and Hong Kong applications afterward. So the 14 months weren't just about getting one license. We basically built a reusable playbook for regulators anywhere in the world evaluating this kind of products for the first time.
Actually, before we jump to the next section, it's funny because Binance, for example, even though they had strong user base, a lot of financial strength, you see that regulators, they just don't care. Like they miss, for example, to get into the MiCA license on time, and they are definitely having a hard time, their users and Binance themselves. So it's a very important topic, regulation.
Agree.
So let's stop a serious talk for a second, and let's jump into our triple W section, Web Wide West, Web3. Are you ready, Anastasia?
Yes, let's try.
Perfect, let's go.
That's awesome. So we're gonna shoot quick questions here, and the first one is 90% of tokenization talk on LinkedIn just pure marketing hype? Yes or no?
Yes.
Bank blockchain pilots, genuine innovation or corporate theater?
Let's say innovations.
What's the most annoying buzzword in Web3 right now?
Maybe real world assets.
Okay.
Have you ever pitched to the regulator who had zero idea about the technology behind?
Let's say yes.
In 5 years, will traditional finance look completely prehistoric? Yes or no?
No, but maybe in 15 years, I think it's possible.
Great, you did it very well. Let's back to the discussion about the real use cases and some success stories, because obviously you took part in a couple of projects. So you led also the teams who built a tokenized fixed income product that literally sold within a couple of hours after the launch. So please walk us through this exactly. What was tokenized and why did investors buy in so quickly? Very curious.
So this one I'm genuinely proud of because it wasn't a small pilot. It actually shipped and performed. I was the program manager on this and I had multiple teams working on it. I mean, one team handling the tech, another blockchain, other teams handling the business and regulatory side. And they had to stay perfect in sync the whole way through. Together with a partner, Arabian Gulf Capital, we built a way for brokers to take their own investment products and offer them directly to clients through our platform instead of going through the usual slow experience, expensive route. The very first product we launched this way was basically a bond, a portfolio of fixed income securities packaged up. So each piece of it was issued as a digital token on our regulated platform. And it sold out within hours. And now the main question, why did that happen so fast?
Exactly.
Yeah, honestly, it wasn't because retail investors suddenly discovered crypto and rushed in. It was much more boring than that, in a good way. I mean, Arabian Gulf Capital already had relationships with hundreds of existing clients. Traditionally, if a broker want to launch their own investment product, that's a slow, expensive process. You are setting up a dedicated fund or working through third-party structures, dealing with a lot of friction and cost. And what we did was remove that friction entirely. I mean, the broker could issue their own trading strategy as a fully regulated product directly without building a fund from scratch. So when it launched, it wasn't a cold start. It was going straight to a warm existing base of investors who already trusted the broker. Now with a faster, cheaper, more flexible way to access the product plus secondary market liquidity they wouldn't have had before. So really what sold out in hours wasn't hype. It was distribution. We had built the regulatory and technical rails and Arabian Gulf Capital already had the demand sitting there ready to go. Tokenization just removed the friction between the two. So that's actually the version of success I like most in this space, not a flashy launch, just genuinely making an existing process faster, cheaper, and more accessible without cutting any regulatory corners.
Yeah, that actually sounds like a dream scenario. But the reality actually in this industry is often different, Anastasia. So there is what you call a graveyard of pilots. So that means that there are projects that get stuck they get stuck on a testnet and they never see the light of the day, right?
Yeah.
So why do most projects fail? And if it's rarely a technical issue, what are the businesses or legal blockers that kill them?
This is actually a big part of what I did day to day. I wasn't just building things. I was also the person deciding what shouldn't get built or at least not yet. I mean, I put together a prioritization framework specifically for this. Before any project got real engineering time, it had to go through this prioritization framework. We would look at the economics. I mean, does the tokenomic model actually makes sense, what the real return on investment for the customer, and separately what the profit for the platform, because those two things aren't automatically aligned. We would assess risks, and critically we would check how ready the legal foundation actually was, because that's usually where projects quietly die later if you skip it early. The goal of that whole framework was really just to fail fast on paper instead of failing slow in production. And the reason a project gets stuck are honestly more varied than people expect. Sometimes it's genuinely that the market doesn't need it. I remember looking at tokenizing certain natural resources, and the reality was in a region like the Middle East, it's already perfectly fine to have multiple suppliers at different price points. And tokenization wasn't solving a problem anyone actually had there. Then sometimes it's the framework itself catching a mismatch. I mean, the economics just don't work, or the structure doesn't fit the regulator's rulebook. And here is the tricky part. Sometimes you can force it to fit the rulebook, but by the time you do, you've striped out whatever made the product attractive in the first place. So you are left with something fully compliant and completely uninteresting and unuseful. Sometimes it's just timing. I mean, onboarding, getting a white paper approved, all of that takes real time. And if the project is, say, a fundraising play, the business needs the capital faster than the regulatory process can move. By the time you are compliant, the opportunity is gone. And sometimes, honestly, it's not the product at all, it's internal. Maybe a business owner changes priorities, leadership shifts into a project that was technically ready, just quietly stops being anyone's priority. Nobody kills it on purpose. It just stops moving. So the graveyard isn't really about bad ideas or bad tech. Most of what ends up there was perfectly buildable. It just didn't survive contact with economics, regulation, timing, or internal politics, usually some combination of all four.
And actually, on that note, because normally every startup pitch deck looks always flawless, but there are obviously some risks which nobody puts into the pitch deck. So when you are actually running this project on a daily basis, what keeps you up at night? Is it like liquidity, custody, or the gap between being compliant and actually trusted by the big institutions?
Liquidity, honestly, yes. That's one that actually kept me up at night. And it also the reason we ended up shelving a project I'm still a little sad about. We built a bridge connecting Hyperledger Fabric, the blockchain which we use to build our platform. This bridge was between this Hyperledger Fabric and a public blockchain Ethereum. So we built it, it worked, it reached testnet, but it never went into production because when we really looked at it, the liquidity on the other side just wasn't there yet to justify running it live. That's actually a deeper point about this whole industry. Being in a regulated environment is a good thing. It's what makes institutions trust you, but it also naturally limits your liquidity. You can't just let anyone trade anything, anytime, the way you can on an open crypto exchange. Every restriction that makes you compliant is also, by definition, a restriction on how freely an asset can move. So you are constantly balancing compliant enough to be trusted against liquid enough to actually be useful. The other thing that quietly keeps people up at night and almost never makes it into a pitch deck is a much simpler question. Does putting this specific thing on a blockchain actually add value? Sometimes the honest answer is not really. The technology works, the token is real, but if it doesn't meaningfully improve speed, cost, or access compared to how it was done before, you just built something technically impressive that nobody actually needed, unfortunately. And then there is everything around the product that has nothing to do with blockchain at all. Just normal business reality. Competition from other platforms doing something similar. How partnerships are structured, who owns what part of the relationship, what happens if one side wanna renegotiate terms later. None of that shows up in a pitch deck either, but it can quietly kill a project just as easily as a technical failure. So if I had to sum it up, the gap between compliant and trusted is real, but for me, the bigger, quieter risk was always liquidity and honestly knowing when a technically great product just doesn't have a strong enough reason to exist yet.
Fantastic. We are getting to the end, actually, Anastasia. Let's look at the global map. We are every time touching base on the regulation, and actually regulation varies widely region by region, right? Who is actually leading the race between MiCA in European Union, VARA in Dubai, for example, CVE in Bahrain, and any other jurisdiction? Who built frameworks specifically for this, and who is just retrofitting old rules, maybe? Are we reusing things that didn't work in the past now into this new tokenization era?
This is actually a topic I have strong opinion about because I've lived inside one of these models and I'm watching the others from the outside. So let's start with Bahrain, since that's the one I know from the inside. Bahrain actually moved in credibility early. I mean, they issued their first crypto license all the way back in 2019. And the CBB has kept updating the rulebook since then. If I'm not mistaken, they updated the digital token offerings rules in 2023 and stable coins rules in 2025. So credit where it's due, they were genuinely first. But here is the thing about that model. It's a fixed rule book. You test for a period, you get license, and then you operate strictly within what already exists. When we were building something that didn't fit neatly into that existing box, what we got back wasn't a conversation. It was a rejection. The rulebook doesn't bend around you. You have to bend around it. MiCA in Europe is a bit similar in spirit. It's comprehensive unified framework, which is genuinely impressive at that scale, but it's still fundamentally a rulebook you comply with, not one that's been actually co-written with the companies building inside it. VARA in Dubai, I would put it in an interesting, I think, middle category. It was built specifically for this from day one. No legacy securities law being awkwardly retrofitted, which gives it real flexibility. And you can see that in how fast real institutional products are launching there. But honestly, the one I find most exciting right now is the UK. The FCA runs something called the Digital Securities Sandbox, and it works completely differently. I mean, you have got 16 companies right now testing real issuance, real trading, real settlement together with the FCA and the Bank of England live. Firms like Archax are tokenizing money market funds with names like BlackRock, State Street, Fidelity, and others. That's not a demo for a pitch deck. That's live infrastructure being stress tested inside the regulatory conversation itself. So the real difference isn't really about who's faster. It's about the model. I mean, Bahrain's approach is prove yourself, then operate inside a fixed box. The UK's approach is built inside the room with the regulator and let the rules get shaped by what actually works in practice. My honest take, being first like Bahrain's doesn't automatically mean being right long term. A regulator that understands a product from the inside because they helped stress test it tends to write better rules from my opinion. Better rules attract more serious capital and that compounds. So my bet is the UK ends up several steps ahead, not despite moving slower, but because of how it's built in.
And indeed, like regardless who is the fastest, actually, as you mentioned, like big players are in and big money are coming as well. So if we look like 2 years into the future, where the real value is going to be. So we hear a lot about the money market tokens and tokenized securities. So from your perspective, what is currently overhyped and what is, in contrary, massively underpriced or ignored at the moment?
Honestly, I think tokenized treasuries are a bit overhyped right now. Just to explain, treasuries are basically government debt, like United States Treasury bills, consider it one of the safest investments in the world. Tokenizing them just means putting that same safe asset on a blockchain so it settles faster and moves more easily. It's not a bad idea, but everyone's chasing the same obvious asset because it's the easiest one to tokenize. It's a bit boring. You're just making something already safe, slightly more efficient, not solving a real pain point. What I think is genuinely underpriced is trade finance and private credit. Trade finance is essentially the paperwork and financing that makes global trade actually happen. Think of a shipment of goods leaving a factory in one country and needing financing and documentation before it arrives and gets paid for on the other side. Private credits is direct lending to business outside of traditional banks. Nobody talks about this on stage. They are not so sexy, but that's exactly where tokenization solves a real painful problem. These markets are slow, full of paperwork and hard to access. Tokenizing them actually fixes something broken instead of just putting a shinier wrapper on something that already worked fine. So the other one I would flag is real world collateral movement. In simple terms, imagine a bank needs to provide, it has enough asset backing a transaction in real time to another bank before a trade can settle. Traditionally, that's slow, involves a lot of manual back and forth. We are already starting to see this with tokenized assets moving as collateral between banks in real time, like what's happening in the UK Sandbox. It's unglamorous infrastructure work, but that's genuinely where a lot of hidden cost and delay in finance disappears. So my honest take, everyone's excited about the shiny, safe stuff and ignoring the boring, painful stuff, which is usually exactly backwards from where the real value ends up being.
We're all like little diamonds, right? But sometimes it's worth to see what is behind, hiding, maybe in the shadow.
Yeah.
I really like it, that use case that Anastasia you explained, and actually I shared your opinions. We are reaching our very last question, so we need to wrap things up. But we always like to leave our audience with one clear takeaway. We've talked about use cases, why others project failed, regulatory compliance. But if there is a single myth or misconception about tokenization that you could kill for good right now, what would it be?
I think if I could kill one myth for good, it will be that tokenization is about replacing the asset with something risky and speculative. It's actually the opposite. Tokenization doesn't change what the asset is. It changes how easily you can access it, trade it, and trust that the record of who owns it is accurate. The gold bar is still a gold bar. The bond is still a bond. We are just giving it a better, faster, more transparent way to move. So if there is one thing I would want people talk away with, it's this: tokenization isn't about making finance riskier. It's about making good real assets easier to reach for more people. And that's genuinely exciting.
Absolutely. It's always about changing the rails for a better infrastructure. Like, that's fantastic. So, Anastasia, Thank you so much for your time, experience, background. We really appreciate that you were here. We had to pack so many years of experience in 35, 40 minutes. So it's always a challenge, but I hope people can get a lot of insights, a better understanding of what tokenization is and why we're talking about it again right now.
Thank you for inviting.
Thank you as well for putting everything so clearly using this very easy wording. I think this is what we need these days, just to make these topics approachable for all the people who would like to learn a bit more. So it was great to have you today. Thank you so much.
Great. Thank you for inviting. And yeah, I wish you good luck with your forthcoming episodes.
Perfect. Thank you.